before we actually get into the nitty-gritties of it, just for the benefit of everyone watching, I want you to explain in very simple and basic terms what exactly is hedging when it comes to an investment portfolio and how it can add value to it.
Okay. When you build your portfolio, you make the investments with the intention of earning returns,
Correct.
building wealth.
Yes.
Okay. You basically have an optimistic view of the market.
Yes.
The market should go up, but markets often correct very deeply, and even over a prolonged period of time.
Yes.
Okay. Like during 2008 global financial crisis, stock market corrected by 60%.
Yes.
And recently during the COVID crash also, stock market corrected once by 40%. Okay. And it's just not stock markets. Even bonds correct. People typically consider that bonds are pretty safe, but they also correct.
Yeah.
Take the example of US Treasury bonds, which are considered the safest asset in the world. Safest asset, I would say. Okay. Long-term US Treasury bonds have lost nearly 60% of their values in last 4 years.
60%?
60% of their value in last 4 years. 60% losses you're talking about. Consider a pensioner. Okay. Consider a pensioner who has invested in treasury bonds, consider them safe assets. Okay.
Right.
And in last few years, inflation has been there. So 20-25% cost of living has increased. So person is looking at really 85% wealth erosion. Okay.
And these are in
US
Treasury
bonds I'm talking about. Okay. So every asset need hedging. Every asset.
Wow.
If your core asset is a US Treasury bond, even that needs hedging. That's my point. This year, we are in 4th year of losses. And if things don't change, okay, as they are right now, they would be ending a 4th straight year in losses. Okay.
Wow. That is actually crazy. So when you say hedging, and that is why when we talk about hedging.
So I'm now coming to hedging. So this is your definite. So that's why you need to protect. You need some protection against the losses. Okay. So hedging is the technique of making investments with the intention of protecting your core portfolio against losses.
Right.
Okay. So if let's say you have invested in Reliance share, okay, so 100 rupee share is there, okay, and it is depreciating by 70 rupees. There is another investment that you have made, okay, there's depreciated to 70 rupees, and there is another investment that's a hedge. That is a hedge investment, okay, investment with the purpose of hedging.
Right.
Okay, it's done. That will give you 30 rupees. Okay, to cover up your loss.
So
it's like the portfolio insurance, you can say, in simplest terms.
Yes.
Okay.
Yes.
And it helps. See, the biggest risk in wealth building journey for generally for investors is that there would be some market downturns on the way. During those market downturns, they lose confidence in their portfolio or in their manager or in themselves.
Right.
Okay. And they take out all the money and book all the losses. Okay. And invest in a risk-free FD. Okay.
Correct.
That's the major risk in stock market. The people cannot stand the journey. A lot of people have entered after 2020. They feel that every correction is an opportunity.
Right.
It doesn't work like that. In 2008, when market crashed, they gave 0% return for next 6 years. Okay. Okay. 0% return was there.
And that's when this theory gets tested very, very much, where it's one thing to know it intellectually, that, you should buy when the market is low and sell when the market is high. But it is not that easy to practice.
It's not that easy. It's not possible. At the time when you should actually average out, people actually take an exit. Okay.
Right.
So hedging basically reduce your losses in the market. Okay. And the cash that you get in hand due to hedging process,
right,
it gives you opportunity to average out at the bottom. Understand this with some real numbers. Okay?
Right. Yeah.
So market was at around 6,000 level. Nifty 50 was at around 6,000 level in December 2007.
Okay.
At the end of December 2007.
Okay.
It made a bottom in November, then again made a bottom in Feb 2008. Okay.
Okay.
And then eventually recovered to 6,000 level again by December end, December 2010.
Okay.
Okay. So in 3 years, return was 0%. Okay. So now let's say Nifty made a bottom in November 2008.
Okay.
Okay. It went to around 3,000. Okay. So if you have done the hedging,
okay,
you have a loss of 3,000 in your main portfolio.
Correct.
But your hedging gives you another 3,000 to cover the losses.
Okay. Whatever the instrument.
Whatever
may
the instruments are.
Ah.
Okay. Now, and you invest, first of all, you have some protection. Your losses are zero. Okay. Second thing is that 3,000 you can invest in market at the bottom. Okay.
Okay.
So your average buy price now become 4,500.
Okay. Got it.
And by the time your market has recovered and you reach December 2010, you are sitting on the gains of 40%.
Right.
Okay. That's how hedging helps. Okay.
So hedging helps technically in this example that you said, even though had you not hedged and just held, even as an investor who genuinely believed in long term, you held the entire portfolio through those years, you still ended up with zero returns.
Santosh, it's very easy to say that you could have held. See, there's 0% return for 3-year holding period. Cost of living has went up by 20%.
Right.
Okay, interest rates were increasing. FD was offering 6, 7, 8%. Real estate, it literally became doubled during that period due to low interest rates.
Right. Correct.
Okay.
Correct.
So people cannot hold securities for such a long
It's
time.
easier
It's not
said than
possible.
done.
It's not possible.
Correct.
Okay.
I
so
agree.
hedging allow you to complete the journey.
Right.
Okay. And that's why hedge funds are quite popular among the sophisticated investors.
This is where different kind of tools come into play of when it comes to hedging, right? So we have from the very popular in people's imagination, which is the whole F&O, the derivative segment, to other assets beyond the market, to even AIF and other kind of instruments that these sophisticated investors use. So how should one decide, depending on the kind of investor you are, what is the right hedging tool for you?
See, there are two techniques to hedge your portfolio.
Okay.
And I will make you understand with a very simple example. Okay. So let's say you have invested in a refinery. Okay. You are running a refinery business. Your wealth is tied up there. Okay. You are running that refinery. Okay. Now, for refinery, the main risk is crude prices.
Yes.
When crude prices go up, your margin reduces, shrink. And when crude prices goes down, your margin increases. Okay. Yeah. So now, as an investor and a business owner, you know that in the 12 months, this is going to be my crude demand. Okay. So when oil prices recently went down to $68 per barrel, you basically went into a contract. Okay. That basically fix your input price at $68 for next 12 months.
Yes.
Okay. You basically went into a contract. So this is a hedge now. This is a hedge instrument.
Correct.
Okay.
Correct.
So now when prices went up to 78 again, just yesterday, okay, it touched 78 again yesterday, you are protected. Because you have, because when you are buying price at 78 from the market now, there is a contract that is giving you 10 rupees. Okay?
Yes.
That is covering your gap,
Correct.
covering your loss.
Correct.
Okay.
Correct.
So you are hedged. So this is called direct hedging.
Direct hedging. Okay.
This is called direct hedging, where you would buy an instrument specifically for the purpose of hedging your main portfolio.
Okay. So another example of this would be, say, an export importer or import exporter taking a direct hedge against the currency fluctuation. Yes.
Okay. Like Infosys gets its revenue from US. Most of its revenue from US. Yeah. Okay. So if Indian currency depreciates here, it makes more money.
Yes.
If Indian currency appreciates, it makes less money. Less money.
Yes.
Okay.
Yeah.
So if it believes that the dollar is going to depreciate and Indian currency is going to appreciate, okay, it has not happened in a very long time.
Right.
Okay.
Right.
But let's believe that is a scenario. They can take a contract. We will fix the currency rate for them.
Okay.
Currency rate for them. Even if currency appreciates or depreciates, their returns are same. Now let's understand diversification-based hedging.
Okay.
Here the key is to identify assets for diversification which have low correlation.
Got it.
So if you say, okay, I have a TCS in my portfolio and okay, I am diversifying into Infosys, that's just a diversification. That would not provide any hedging advantage.
Right.
Okay. That would not provide any hedging advantage. So typically,
and the reason why it will not is because both are pretty much in the same business,
same industry,
and they
same
will be
exposure,
impacted by the same things.
Same thing.
Right.
Okay. So whenever you are mixing two assets for purpose of hedging, diversification-based hedging technique, okay, primary condition is low correlation.
Low correlation.
They should not move together.
Yes.
Okay. So it's a common practice to mix equity with, bonds.
Yeah.
Bonds have perfect correlation is 1. Perfectly negative correlation is -1.
Right.
Between the two assets. Okay.
Mm.
Typically, bond and equity have zero correlation.
Yeah.
It's not perfectly negative, but it's
Yes.
zero.
Yeah.
Okay. Gold and equities typically have slightly negative correlation. -2, -0.2, -0.3. Okay. So a diversified portfolio
Right.
can protect against adverse market movements. You can also go for international equities. Okay.
Right.
Like Nifty 50 and Nasdaq 100. Okay. They between them the correlation is around 0.2%.
Right.
Okay. That is also one more option, and here the also return potential is better. Okay,
Right.
because they are on equity side.
Right.
Thing is that investors should have a long-term view on that. They should not compare the returns in 3 years or last 1 year. They should consider that portfolio is going to be there for 10, 15, 20 years. Okay,
Right.
because returns are definitely lower with bonds and gold, and you are comparing a 6-month, 12-month returns.
It won't work. Yeah.
It won't work. Okay, you feel like it's not worth it.
Right.
Okay, or the long-term cycle, you will see 2 or 3 down cycles. There, the protection is provided will make up for the underperformance during the bear market. Bull market.
Right.
Okay.
Right.
So that's called diversification-based hedging.
Right.
You should understand what is your main investment. What is your core portfolio?
Correct. Okay.
Okay. You cannot be confused.
Yes.
You have taken some position for hedging and now you are banking on that particular position for returns.
Correct.
Okay.
Correct.
The idea is to make wealth from your core portfolio
Yes.
with some protection against the downside.
Right.
Okay. If you do 100% hedging, let's say on Nifty, let's say you have position Nifty 50 ETF and you go for 100% hedging, there are zero returns. There are zero returns. Okay. Okay. So when you are applying direct hedge specifically, it has to be very strategic.
That is the whole idea of a hedge, right?
So let's say Nifty has made a big move. Okay, Nifty has made, let's say in 1 month, Nifty has made a nearly 20% move, 10% move.
Yeah.
Okay, let's say. Okay, or 5% move. 5% move for Nifty 50 is decent. 5% move in, let's say, just 15 days. Okay. So there is a chance, there is a risk that it might correct.
Yeah.
To a certain extent, it might correct. Okay. That time you can take some hedge. 20, 30% or 50% hedge you can do. But you can remove the hedge.
Right.
Once that is done. So it has to be, timing is important. How much you are hedging, that is also very important. Okay. Normally, direct hedging should be deployed only by expert investors.
Right.
Okay. Second key aspect is cost of hedging.
Yes.
Okay. Hedging is not free.
Yes. Yeah.
Options, futures that you deploy, they also come with cost. Their trading cost, their transaction cost. You have to deposit, in case of futures, you have to deposit margins. Okay. There is an opportunity cost which is there. Okay. So they are coming with their cost.
Correct.
Okay.
Correct.
So cost should not outweigh hedging benefits.
Yes.
Okay. That has to be considered.
Yes.
Okay. In case of when you're going for diversification, okay, diversification-based hedge, you have to understand that, yes, if you diversify, do a very high allocation to bonds, okay, you do a very high allocation to bonds, let's say 50% allocation. Yes, your portfolio is protected against the downside.
Yeah.
But in case of upside, you are missing a lot of gains. You're missing out on market rally, and that's a very huge opportunity cost.
Exactly.
So hedging is like coriander. Okay, when you're making a vegetable curry, okay, it's like a coriander. If you use it in a limited quantity,
yes,
it will provide a different flavor.
Yes,
okay, which will add to the taste of the curry.
Yeah.
But if you put it in the same quantity as the other vegetables, okay, entire set, you have a, let's say 500 gram potato, and you put 500 gram coriander, okay, so then the curry would be nothing. There would be it would be a mess actually.
Wow.
You don't know what
you're transitioning into a resident poet, man. That's
how hedging should be looked into. It's like a coriander in the curry.
Right.
That's what it is to your portfolio.
One, apply it in practice. Like, how do you know when the market is moving and make the allocation change, and when what percentage do you change?
See, the perfect way of doing it is to basically rotate portfolios in line with market conditions. Okay.
Okay.
So let's say you have a bullish view on the market, you go high on equity, okay, and once you feel that there's a reversal going to be happening, okay, there's going to be a reversal,
Right.
short-term reversal, okay, or maybe a full-fledged bearish
Okay.
turn, okay, you can increase the exposure to safer asset classes. You can make safer asset classes, or maybe you can move into safer section of equities, okay, like low vol equities you can move if you feel that bearish turn is there.
Right.
Okay, that's the relatively more reliable method of implementing hedging to your portfolio, where you are not doing any explicit hedging, you are just churning the portfolio in line with market conditions. But for that you need you need to be a market expert. Okay, and that's where we also have a strategy, dynamic factors, okay, that is there, which take tactical calls based on the market trends and do the shifting. But having said that, just try to understand always. As I already mentioned, what is your core portfolio?
Yeah.
There are some people who are expert at real estate. Okay, and their portfolio would be 90% real estate only, because they understand it.
Yeah.
Okay. As a normal retail investor who has a normal job in IT, a general job in IT, okay, and who is basically looking towards investing as wealth building,
Right.
okay, you have to always recognize that your core portfolio lies in equities, mutual funds, and debts.
Correct.
And debt instruments.
Right.
Okay.
Right.
Even if real estate or angel investing opportunity is giving you outsized returns once in a while, do not think of increasing the allocation to these asset classes.
Right.
You should be just happy that when your initial portfolio was underperforming, these hedge instruments covered up for the gap.
Great. Yeah. Okay. So thanks a lot for this. And once again, even for you guys, if do let us know how do you like what we are bringing to you. And if you have any questions, any suggestions, please feel free to give us. And do subscribe to follow this kind of content. Thank you very much.